Today, we raised the policy interest rate by 100 basis points, 1 percentage point. An increase of this magnitude in one meeting is very unusual. It reflects very unusual economic circumstances. Inflation is nearly 8%, a level not seen in nearly 40 years. I want to explain to Canadians why we took this decision. There are three key considerations. First, inflation is too high, and more people are getting more worried that high inflation is here to stay. We cannot let that happen. Restoring price stability, low, stable, and predictable inflation is paramount. Second, the Canadian economy is overheated. There are shortages of workers and of many goods and services. Demand needs to slow so supply can catch up and price pressures ease. And third, our goal is to get inflation back to its 2% target with a soft landing for the economy. To accomplish that, we are increasing our policy rate quickly to prevent high inflation from becoming entrenched. If it does, it will be more painful for the economy and for Canadians to get inflation back down. With these important considerations in mind, the Governing Council decided to front-load the path to higher interest rates today. This is our fourth consecutive interest rate increase since March. Inflation is broadening because the Canadian economy is in excess demand. There aren't enough goods and services to meet the demand we're seeing as people enjoy a fully reopened economy. Employers can't find enough workers, and they're increasing wages to attract and retain staff. With households spending robustly, businesses are passing on higher input and labor costs by raising prices. Higher interest rates will help slow demand and allow supply time to catch up. Consumer spending will moderate as the pent-up demand from the pandemic restrictions eases and the cost of borrowing increases. Housing market activity is already cooling rapidly from unsustainably high levels during the pandemic. And slower global growth will reduce demand for our exports. Taking all this into account, we are forecasting annual growth in economic activity will be around 3.5% this year, 1.75% next year, and 2.5% in 2024. As global bottlenecks gradually resolve and tighter monetary policy works its way through the economy, inflation will start to come down. While we may see a few more months with CPI inflation close to 8%, we expect it to decline later this year, ease to about 3% by the end of next year, and return to the 2% target in 2024. This is the soft landing we are projecting. Interest rate increases can cool demand and inflation without choking off growth or causing a surge in unemployment. Some sectors will be more affected by interest rate increases than others. But the very tight labor market means there is room to reduce the number of job vacancies without having a big impact on overall employment. And with the prices of many of the commodities we export expected to remain elevated, the global forces slowing growth will not affect Canada as much as in many other countries. But the path to this soft landing has narrowed, because elevated inflation is proving more persistent. And this requires stronger action now so consumers and businesses can be confident that inflation will return to the 2% target. Our decision today takes the policy interest rate to 2.5%. That puts it in the middle of the long-run neutral range that neither stimulates nor restricts growth. We estimate that range to be between 2% and 3%. We continue to expect interest rates will need to rise further to cool demand and achieve the inflation target. How high our policy rate needs to go will depend on how the economy and inflation evolves. By front-loading interest rate increases now, we're trying to avoid the need for even higher interest rates down the road. Front-loading tightening cycles tend to be followed by softer landings. This argues for getting our policy rate quickly to the top end or slightly above the neutral range. We also reviewed measures of inflation expectations at some length. The prevailing view in consumer and business surveys is that the Bank of Canada will ultimately control inflation. At the same time, these surveys clearly suggest that inflation expectations have moved up and are becoming more dispersed, with more respondents now seeing high inflation persisting. Market-based measures of inflation expectations over the next 2 years, as well as the projections of professional forecasters, have also risen, though they remain consistent with the 2% inflation target over the longer term. While the Governing Council was reassured that the inflation target remains credible overall, we recognized this credibility is being tested. Demand in the economy is running ahead of supply, inflation is high, and uncertainty about the future of inflation, the future path for inflation, has increased. All of that led us to the decision we took today to accelerate the path to higher interest rates. We did not take this decision lightly. We are acutely aware that higher interest rates will affect Canadians who are already feeling the pain of high inflation. It can seem counterintuitive to add to the interest costs Canadians face in order to combat the cost of inflation. But by increasing the cost of borrowing, we will moderate spending and return inflation to its target. We need to get price changes back to normal. This matters because it gives people predictability to plan their spending and saving decisions, to budget, and to live their lives without having to worry about what prices are going to be next week, next month, or next year. The best way to protect people from high inflation is to eliminate it. That's our job, and we're determined to do it. The Governing Council is resolute in its commitment to price stability. And with that, Carolyn and I would be pleased to answer your questions.